The nature, source, and purpose of management information. Understanding management information, the foundation of business decision-making. Welcome to Management Accounting. Management accounting is the process of identifying, measuring, analyzing, and communicating financial information to aid internal decision-making. This module will help you understand how management information drives strategic business decisions. Key objectives we'll cover include assisting managers in strategic planning and control, supporting performance evaluation, optimizing resource allocation, providing insight into financial and non-financial factors affecting business performance. Financial versus management accounting key differences. Users. Financial accounting, external users like investors and regulators. Management accounting, internal users like managers and executives. Regulations. Financial accounting must follow IFRS/GAAP standards. Management accounting, no strict regulations, flexible approach. Time orientation. Financial accounting, past-oriented, historical data. Management accounting, future-oriented, planning focus. Detail level. Financial accounting, summarized reports for general overview. Management accounting, detailed reports for specific decisions. Primary reports. Financial accounting, financial statements for external stakeholders. Management accounting, budgets, variance reports, cost analysis for internal use. Characteristics of quality management information. Relevant information must be useful for the specific decision at hand. Accurate data should be free from errors or misrepresentations. Timely information must be available when needed for decision-making. Complete should include all necessary details for informed decisions. Understandable must be clearly presented to decision-makers. Cost-effective benefits of collecting and processing data should outweigh the costs. Example, a monthly sales report provides timely information for inventory planning, while overly technical reports may not be understandable to all managers. Sources of management information. Internal sources provide data from within the organization. Financial data, income statements, balance sheets, cash flow reports. Operational data, production output, inventory levels. Employee data, labor hours, productivity reports. External sources provide market context. Market trends, customer demand patterns, competitor analysis. Government reports, economic indicators, taxation laws. Supplier and vendor data, pricing trends, delivery performance. Example, a business tracks monthly sales data internally and competitor pricing externally to adjust its pricing strategy effectively. Management information systems. Transaction processing systems, TPS. Record day-to-day business transactions like sales and payroll. Foundation for all other information systems. Management information systems, MIS. Convert raw data into meaningful summaries. Example, monthly sales reports from transaction data. Decision support systems, DSS. Analyze complex data for strategic decision-making. Example, investment analysis and scenario planning. Enterprise resource planning, ERP. Integrate data across all departments. Examples, SAP, Oracle systems connecting finance, HR, and operations. Understanding data versus information. Data represents raw, unprocessed facts. Example, sales in January equals 5,000 units. Numbers without context or meaning. Information is processed data with meaning. Example, sales increased by 10% compared to December. Data transformed into actionable insights. Key differences. Sales figures, data $100,000 revenue. Information, revenue increased by 5% from last month. Inventory, data 500 units in stock. Information, stock levels are 20% lower than usual. Cost classification fundamentals. Fixed costs do not change with production levels. Examples: rent, management salaries, insurance. Variable costs change directly with production levels. Examples: raw materials, direct labor, utilities based on usage. Semi-variable costs contain both fixed and variable elements. Example: electricity with fixed connection charge plus usage costs. Direct versus indirect costs. Direct costs, directly linked to production, materials, direct labor. Indirect costs, overheads not directly linked to products, office expenses, management costs. Break-even analysis. Break-even point represents the level where total revenue equals total cost. Formula. Break-even units equals fixed costs divided by selling price per unit, variable cost per unit. Practical example. Fixed costs equals $5,000. Selling price per unit equals $50. Variable cost per unit equals $30. Break-even units equals $5,000 divided by $50 to $30 equals 250 units. This means the business must sell 250 units to cover all costs. Costing methods comparison. Marginal costing includes only variable costs in product costing. Formula: variable costs only. Absorption costing includes both fixed and variable costs. Formula: variable plus fixed costs. Example comparison. Variable cost equals $30 per unit. Fixed cost equals $10 per unit. Marginal cost equals $30. Absorption cost equals $40. Each method serves different decision-making purposes. Budgeting and performance measurement. Budgeting purpose. Financial planning for future operations. Cost control and resource allocation. Performance evaluation against targets. Budget types. Sales budget, expected revenue projections. Production budget, planned output levels. Cash budget, cash inflows and outflows management. Variance analysis. Variance equals actual performance, budgeted performance. Favorable variance, better than expected results. Adverse variance, worse than expected results. Ethical considerations. Integrity. Avoid misleading reports and maintain honest communication. Present information accurately without bias. Confidentiality. Protect sensitive company data and information. Ensure information security and privacy. Objectivity. Provide unbiased information for decision-making. Avoid conflicts of interest. Professionalism. Follow ethical guidelines and professional standards. Maintain competence and professional development. Thank you for watching. You now understand the foundation of management accounting, including the differences between financial and management accounting, information quality characteristics, and basic cost concepts. These fundamentals will support your learning in the upcoming modules. Remember that good management information drives successful business decisions.